How to sell your business and pay $0 in federal income tax. How do you do this? How do you become eligible? And why it's important for your specific use case to make the best use of this Section 1202 code section. What exactly is this? Section 1202 was enacted back in '93 to encourage investment in small businesses. Businesses formed after September 28, 2010 get a 100% exclusion on the gain from the sale of their business stock, or i.e. the sale of their business. This is very important for entrepreneurs to know whenever they're forming their business and whenever they're starting their business, how they can use this to structure their company and to grow, scale, and exit and pay $0 in federal income tax. How can you do this? The first thing is the stock must be held by non-corporate shareholders. Essentially what this means is has to be an individual. Brooks and Tom, they own, Corporation X. Well, a 50-50 split, we're individual shareholders. So far, we qualify. The holding period is essentially from whenever you purchase the stock or quote unquote start the company, because some people will form their corporation with this from the get-go. The holding period has to be 5 years. December 1st of 2020, holding period all the way to December 1st of 2025. That's a 5-year holding period. Another thing is it has to be the original issuance of the stock. You have to be an original shareholder of the stock. Exception to this is receiving stock through an inheritance or a gift. So if another family member, who however that may be, leaves this as part of an inheritance, that is one of the exceptions to that rule. There's a lot of tricky scenarios to this, to where it's really best to, this video is a very general guidelines, and it's really good to actually schedule an appointment with a tax advisor to really go over your unique situation, because it really is case by case basis. Going on, like how to be eligible, you have to be a C corporation. You cannot be an S corporation. You cannot be an LLC that's taxed as an S corporation. It has to be a C corporation. Another thing is you cannot have over 50 million of tax basis assets at the issuance of stock or the formation of the business. Another thing that is really gonna get a lot of people too is the qualified trade or business requirement. This has some gray area and we're gonna kind of dive into it a little bit. But essentially, let's take my business for example, like my tax and accounting firm. This Section 1202 would never apply to me because qualified trade or business requirement is you cannot be a personal service business such as health, law, accounting, and performing arts, consulting, athletics, financial services, farming, oil and gas, mining, hospitality, hotel, motel, restaurant, or real estate. Those businesses do not qualify. And that sounds like it rules out a lot. Essentially, what this is meant to do is businesses that are heavily reliant on the knowledge of one person. For example, my company would basically not exist if I wasn't a part of it. Like, I'm doing a lot of the work. I know I have help in the team, but my personal knowledge is what the business is. It's personal services. It's tax advising, tax consulting, accounting, bookkeeping, like all of those things. That is what they're trying to kind of rule out. One of the last things, at least 80% of the fair market value of the assets are required to be used in the active ordinary income of the business. So essentially, you can't have a C Corp that holds a bunch of real estate and your primary business activity is, most people will not run into that. I've never seen people really run into that problem of the issue, but that is kind of one of the areas that can not qualify for the Section 1202 gain exclusion. We've kind of go over how can we qualify, what do we need to do to make this happen. Last thing that I want to talk about is a lot of people are going to be watching this video are going to say, well, my company was formed as an LLC. Is there any way that we can elect to be taxed as a C corporation? Even though we formed as an LLC, can we be taxed as a C corporation to qualify for the Section 1202 exclusion? And the answer is maybe. So there is one private letter ruling. It's a private letter ruling a bunch of numbers by, it's like 2016 36003. You can look that up and Google it. It was issued by William Jackson. Branch chief ruled that the LLC that elected to be taxed as an C Corp did qualify. However, before you clip this and take this and post it everywhere, this cannot and should not be used as evidence to support this claim, as it is not legally binding. A private letter ruling is a case-by-case basis. It is not a ruling that applies that sets a precedent. That is not what it is. We have a PLR, or private letter ruling, that's issued by the branch chief, Mr. Jackson, that allowed it. Now, that's the only precedent that we have that are in the tax courts or that are out there in public knowledge. This is not legally binding and only issued for specific cases. For the taxpayer that is out there, here's an option for you. You could get your own private letter ruling or PLR to see if your LLC could elect to be taxed as a C corporation and try to get this 1202 exclusion to apply to your business. That is one option. Another option is to just form it as a C corporation from the start now that you're equipped with this knowledge. The third option is, we've got to get to the C Corp. You could just take an aggressive stance, change your tax selection to be taxed as a C Corp, and wait the 5 years for the holding period, qualify on all the other things that we've talked about, and go from there. Now that is a super aggressive stance, and I personally would advise against that. However, that is an option. There are some very risky entrepreneurs out there that want to have all of the angles available to them. And there you go. Those are basically your three options. So to recap, Section 1202 was enacted to encourage investment in small businesses. The reason being is they want people to invest in small businesses, and there's no taxation. If they invest in a business, they sell at a massive profit, there's zero tax. But the incentive is to inject liquidity into those small businesses. So it was a cool idea, but it's been so long. I mean, this tax law is older than I am. So it's been a while and not very many people know about it, but it is something that you can use to legally, and this is not clickbait, as long as you follow all the procedures and rules and ensure you qualify, you can legally pay $0 in federal income tax on the sale of your business. Bonus tip, if you are in Oklahoma, you can use this strategy combined with the Oklahoma capital gain deduction. Basically, Oklahoma allows you to sell property, and in that description of property is business stock. You can actually pay $0 in state income taxes if you're a resident of Oklahoma, and the resident of Oklahoma applies to you. You can sell your business, pay $0 federally and $0 at the state level, because the Oklahoma capital gain deduction is a lot of the same rules, especially like the holding period and everything, that the Section 1202 small business stock exclusion has. So you can use those in combination and basically wipe out your federal and state tax bill for the sale of your business. I hope you guys enjoyed. For more content, follow and subscribe below.